Slowdown fears are for real. Indian economy grew at the rate of 5.8% in Q4, the lowest since last quarter of FY14. Now, this slump dragged the annual growth to 5-year low in FY19. And with this, India has lost the fastest growing economy tag to China for the very first time in 2 years. Let's do a 3-point analysis of the key reasons behind the drag. What are the top brokerage houses saying, and what is the outlook? 1. What has led to the sharp slide in GDP growth? Stress in non-banking finance companies affecting consumption finance was pointed out as the key reason of slowdown in the fourth quarter by Finance Secretary Subhash Garg. Now, remember, NBFCs have been facing liquidity pressure after the shock default by IL&FS in September last year. Now, the economy is also beset by a consumption slowdown, as is reflected in the falling sales of automobiles, consumer durables, and even the fast-moving consumer goods. Poor performance in the farm as well as manufacturing sector was a big drag on growth. Now, private investment is not taking off, while government spending, which kept the economy afloat during NDA1, was cut back in Q4 to meet the fiscal deficit target of 3.4%. Now, waning global growth and an escalating US-China trade war also are key factors behind the sub-7% growth this time. 2. What are the top brokerage houses now saying? Well, Nomura says that slowdown reflects a combination of global weakness and continued domestic drag, and that high-frequency data also suggests slowdown will continue into Q1 FY20 as well. HSBC believes weaker private sector activity has dragged growth, and slowdown was evident across agriculture, industry, investments and exports, and that growth is likely to recover only in H2 FY20. Deutsche Bank has revised FY20 full-year GDP growth forecast down to 7% from 7.4% earlier. And Citi, on the other hand, says that economic challenges require immediate policy attention. Finance Minister Nirmala Sitharaman has a critical task of arresting the slowdown and is expected to include key measures to lift growth and revive demand in the upcoming union budget. 3. Will RBI cut rates to boost growth? Well, the RBI has lowered the key rate twice in succession in the previous 2 policy reviews, and a further reduction in rates is expected to lift the sagging consumer demand. Top brokerage houses like Nomura, Citi and HSBC expect RBI to cut the repo rate by 25 basis points in the upcoming June 6 monetary policy. Now, Deutsche Bank additionally believes the RBI could also cut CRR by 50 basis points to expedite monetary transmission.